So joining us now is the Stock Trader Almanac's Jeffrey Hirsch. How you doing, Jeffrey?
I'm super. How you guys?
Oh, we're doing great.
We're fantastic. We're
Yeah.
fantastic.
So for our listeners, a great story. It's like we were at the Money Show together, Jeff, and uh, I was doing that little internet interview that they do, and I was there doing a presentation on commodity cycles, and then I come down and do the interview, and then I find out I'm being interviewed by you. And I'm like, so here I am talking about commodity cycles, and I'm being interviewed by the guy that is all about these cycles. I'm like, I better not fuck up, right?
But I put you at ease right away, didn't I?
Oh yeah, you did. Anyway, it was great
Quick
chatting.
question: Did did he did he f up, or was he
No,
good?
I don't think he effed up.
No,
He
he
was
was
a
good.
little nervous, but I'm a pretty comfortable guy. So
It happens. Okay.
Anyway, so Jeff, you put together or you sent over some slides that we'll be able to look at, and what I wanted to start the conversation with is the third year of the presidential cycle. Now,
yeah,
what was interesting is that when we started this Market Huddle podcast. I was like super bearish last year at the end of 2018. The market's like tanking, and I was so sure that the bear market has begun. And Kevin comes out and he does this whole presentation. Obviously, he read your stuff, but he he did a whole presentation on that pre-election year and how it's historically bullish. And it's amazing how this has played out. And so
yeah.
obviously
It
you've
tracks
been
so
calling
closely
this, right?
this year. Yeah,
Yeah. And
hey,
so
it's a
why
good
don't you
slide.
speak to that? And is this a good slide to talk to
Yeah,
about
that's
it?
where
Yeah.
I wanted you to start. Yeah, this is the the mother of all election cycle slides. You can see that pre-election year, the third year, towering high above. I mean, the Nasdaq number on the right just it still amazes me. 28.8% in the third year. I mean, we got almost that on the S&P this year. What are we 20 um almost
23.
what's the S&P year to date? You guys know
We're
offhand?
we're close to 22, 23
Yeah,
clocking.
Right.
it's
Right.
crazy.
More in line is like 15 or so for the Dow and the S&P, but what you see here is the power of politics, the power of incumbency. I mean, if you think about it, I don't know of another major economic world power that has an election the same day every 4 years. What do you guys up in Canada? What's your election? You have a prime minister, right? It's a parliamentary
We
thing.
yeah, we did. We just had one in October,
But
and
is it the same day every 4 years? No.
uh,
No,
no, it
no.
gets called, and you know what? It can
Right.
vary. So no,
You can
it's
have that vote of no confidence. I mean, England has had what, three or two in the past year. They're having another one, I think, or they're trying to get another one with Boris Johnson. But I mean, that's the whole point: is that we have this what we call quadrennial quadrille, this 4 year dance where the person and or party in power is doing everything they in their power to retain power, and that's what drives excuse me, the third year pattern of being so strong because they primed the pump. I mean, we have a page in the new almanac. It's called "How the Government Manipulates the Economy to Stay in Power," and that's what creates this cycle of the third year being super strong and the other years being less strong. I mean, we often had, in the past, had gotten most bear markets and recessions and wars in the first 2 years of a president's term, and election years used to be a bit stronger. But now they've become a bit of a battleground, and we've seen those undecided elections in 2000 and '08 where the market fell apart. Even a few before that, the election years have been kind of flat. Um, so it's just like a lot of the other patterns we cover. It's really a reflection of the repetitive cultural behaviors of human beings.
Right.
Jeff,
And go
if
ahead.
you don't mind,
Yeah,
I got a quick question. I was just wondering, and not to get too cute about this, but has there been any data collected on election cycles with an impeachment proceeding in the books? I know we have
yeah.
to go back.
All
We
three
have
of
to go
them.
back. Yeah, we have to go back to Clinton, right?
No,
How
you
did?
got to go back to Andrew Johnson, 1868.
Ooh, okay.
Johnson was
And
impeached and acquitted by a narrow vote, and the and 1869 was a panic year, a crash because of the growing pains or the impact of the Reconstruction after the Civil War. Then we
Sure.
had
Okay.
Nixon that was about to be impeached, who resigned in 70 August 9th, I think 74, just ahead of a bear market bottom, the last secular bear market bottom prior to '09. And then there was Clinton, who was impeached just after the long-term capital management, Russian ruble collapse, and Asian currency
90,
crisis,
98.
in the shortest bear market on record that ended on August 31st, 1998.
So
So there
that
was a
was
bottom right there.
that was the
Um,
third year, right? That was the third year of Clinton's second term of presidency. Um, was
no,
Nixon's
it was yes, the third year of his second term. No, it was '98.
right?
It was
So
midterm year.
he oh, it was okay. So it wasn't
Yeah.
99, right? Okay.
It was before '99. He got impeached. I believe it was the fall around this time, like the fall of '98, if memory serves.
Sure. Sure. Yeah, you're right.
And but then he was quickly acquitted, relatively quickly, and the market took off. So the only thing I can see is that if impeachment is imminent or happens, it tends to occur around a low point, and I'm not seeing that in the market right now.
Right. Right.
we agree with that.
It's
So
hit a new high at 28,000.
so
It's
what
making my
what
old super boom forecast look pretty.
So what's in store for next year based upon these patterns? What's the starting bias for the fourth year?
Yeah, I mean the starting bias is, I mean, for this year's is sitting presidents running for reelection, which is a little bit more bullish. However, we looked at just the Republicans, which is only 4 years since '49. It's not quite as strong as sitting Democrats running for reelection, but um, you kind of have to. Everyone wants to break it down by party, which is not necessarily as relevant as actual incumbency, unless you get into Congress. So 10.1%. You just had that chart up there. You were teasing
Oh
the
yeah,
power of incumbency chart, the one that's got the red
yeah,
on it.
yeah.
You can see here since 1949, which is the first full 4-year cycle after World War II, you've got sitting presidents running for reelection 10.1% versus 5.3 for all years. And then when you got no sitting president running, what we're calling open field, it's minus 1.6%. So the fact that we've got somebody running for reelection is a bullish influence.
Now, what's your take though on the business cycle and things like that? Like the fact that this is the least based on the National Bureau of Economic Research, that this is the longest business cycle that's been recorded. I mean, does that influence your seasonality work this way? Like, is
No,
that a
it
factor?
doesn't. That
No.
doesn't influence seasonality, our work at all. I mean, it can influence the market, but seems to me these business cycles keep getting longer and longer. Perhaps it has something to do with, Moore's law for the computers and the fact of constant human ingenuity and technological innovation. Bear markets have gotten fewer and farther between and shorter and less deep. Yeah, we had the big one back in '07, '08, but other than that, um, there's I think the business cycle is really lengthening.
Right, right. So I want to move on and ask you about how do you think November will trade? Because you here have the November trading soft pre-Thanksgiving slide here that you were going to share. So here we are in the middle of November at the time of recording, and obviously we're going into the Thanksgiving period. And I want to talk about Christmas rallies in a little bit. But what should we expect here in the back half of November?
Well, back half is, the back end of it's pretty strong, but you can see that little dip there from the chart that we have, in the like fifth through eighth days. We kind of had some of that. We seem to be rallying mid-month right here, like we normally do. This being the what trading day are we at today?
15th.
Well, it's a day, 15th day, but not the train day.
No, it's not the 15th trading day. So we got what?
Like 10th or 11th or something, right?
6, 7, 8, 9, 10, 11. You can see on my chart there that the mid-month spike is has presented itself.
Right.
We've had a little bit of a soft, week after the soft few days after the beginning, and then based on history, we should soften up a little bit before Thanksgiving, but then we tend to rally right through it and into the year end. I mean, into
Right.
month end. Excuse me.
And what do you
So,
attribute that to, Jeff?
I mean, it's cash flows. Not shown here in the back of the Stock Traders Almanac is something called monthly cash flows, and it's driven by the institutions and money managers that control most of the money. And you've got people behaving again consistently, repetitively, collectively, moving money in and out of or mostly into the market at the beginnings and ends of months, and also in the middle of a month. You want to take a guess where that middle pop comes from?
Indulge me.
Yeah.
So that would be no. I won't take it. No. It's the payroll deductions that go into 401ks and retirement accounts.
Really?
We've seen this change over the years where pretty much everybody who's got a regular job out there in the world, which, yes, there's a lot of people there, twice a month, beginning or end, and then the middle, they get an automatic payroll deduction that goes into the market, has to be deployed. And that's what creates that spike, that mid-month spike that we've discovered in the past 2 or 3 decades. That
Now,
wasn't there earlier on.
what's interesting is that I right now a lot of the work that we analyze on our end is looking at around is all based around options expiry. I don't know. Do you do
Mm-hmm.
any work on that? Like the fact that
Mm-hmm.
like all of this gamma is rolling off of the dealer books, and usually. That allows volatility to return back into the markets. Like we've been more or less pinned at 3,100 because of all the huge exposure that's been open there. I mean, do you think that that attributes to some of the tail end weakness in November, like as this rolls? Is that a pattern you see on a lot of the different months as we pass the expiration of each monthly cycle?
We do highlight options expiration, the third Friday expiration for every month. It's different for every month. We find more significance at triple witching,
Yeah,
March, June, September, and December, with, believe it or not, the triple witching trades in June and September during the worst 6 months of the year are less bullish, whereas December especially has a more of a bullish vibe bias around triple witch, around options expiration. Um, November expiration has a little bit of an impact, but uh, expirations are something we track, and it is something that's significant. Um, More so, again, quarterly when you have the index futures expiring, as well as index options and stock options.
right. Right. So Jeff, what I wanted to move on here and talk to you about the January effect, and which I love how you had the title in your slides that it says January effect now starts in mid-December, and
Yes.
and that actually really inspired me to ask the question. First of all, I wanted you to talk about the January effect in detail, but what I have found is that as everybody starts to realize and these kind of terms start being used, it seems like more and more traders try to front run a
Most
seasonal
definitely.
pattern, which moves the whole thing over. And so, why don't you speak to that? Like, what have you noticed when? Because you're the one who analyzes this in
Yep.
detail. What have you found? What should we expect for the January effect? And is that the Christmas rally? Is that what we should be expecting
No,
from a?
it's different, and the Santa Claus rally is something
Is it
different,
different?
though it happens within this time frame as well. But first off, yes, front running has impacted many of these patterns over the years. Um, they've shifted, they've come back, and that's part of our job, is to keep track of those shifts and make sure they're not just fickle short term variations that that get smoothed out over time. I mean, I won't declare anything changed with anything less than 21 years, and I'll still question it. But we look at long-term patterns, intermediate-term patterns, and short-term patterns, and we layer them on top of each other to see where that, the real frequency and magnitude exists over multiple time frames. So for the January effect, it was a long-standing observation in the market, original work that I found done in the 40s by a gentleman, an investment banker named Sidney Wachtell, showing that small caps tend to outperform large caps in the month of January. They still kind of do, as you can see in this chart, but what we found comparing the Russell 1000 to the Russell 2000 is that most of this move takes place in the last 2 weeks of December. You're seeing that anticipating, and also the sort of ending of tax loss selling. And we try to leverage this with a strategy we call the only free lunch on Wall Street, which I think is in this deck too, which piggybacks with the Santa Claus rally as well as the small cap. But you like that line, the only free lunch on Wall Street?
Yeah, I love it.
It's not free. There's commissions. It's not perfect. It works much better when you get a big sell-off like we had. But I can tell you how that works also. But just to finish up on the January effect, it's really the small cap effect that takes place, mid-December, last 2 weeks of December, where small caps start to outperform. There's my free lunch right there.
Yeah.
And the Santa Claus rally, since you mentioned this Christmas rally, which
I want you to explain this to me.
A misnomer. The Santa Claus rally is not necessarily something to trade. It's almost more of an indicator. The phrase is, my father was a songwriter who started the almanac, and he was able to coin some pretty cool terms. The line we use is, if Santa Claus should fail to call, bears may come to Broad and Wall. And
nice.
Yeah.
I love it.
It's a nice thing to remember. And what happens generally is at the end of the year, that then the Santa Claus rally, which gets misquoted all the time, and it was discovered by Yale in '72, along with the January barometer, not to be confused with the January effect, is the Santa Claus rally is the last 5 trading days of the year plus the first 2 trading days of the new year. And you generally have the S&P up about 1.5%, not huge, but it's pretty solid and consistent, because you have a lot of us away from the big market and the pros at the trading desks and market makers and such picking up bargain stocks that have been sold for tax loss selling, and it tends to have a bullish bias. And when that doesn't transpire, that's an indication that the folks who really are on the inside aren't so enamored with the prospects for the stock market, and they aren't buying stuff up during that holiday quieted 7-day trading period.
Right.
Jeff, just to go back to last year, I mean, I remember that. I think that was the bottom right before Christmas, and after
I call it the Christmas Eve crumble.
You know what? Jeez, you got a great jingle going. I mean, a real talent there, Jeff. But I mean,
yes.
And 2008, if I'm just going way back, they didn't buy it because we went down all the way to March 6th, if I'm not mistaken, in 2009.
Yeah, but
so
I think you're mixing and matching some things there.
Okay.
What is going down on March 6th have to do with the Santa Claus rally?
No, I'm talking about that the 5 trading days before New Year's, getting in on
It's
stock.
Before and after. The 07, 08 was horrible.
Right.
And we had the market fall apart after that. The Santa Claus rally 08, 09 was pretty solid, and we had a bottom on March 6th.
Right.
So I want to make sure we squeeze this into the main part of the interview before we get to the after hours. And I really wanted to talk about that seasonality of the sell in May and go away. But I love the line you have here, buy in October and get yourself sober. And that's so sad, because I just can't imagine on this Market Huddle podcast getting sober in October and staying that way. But
it just rhymes.
It just rhymes, right? But
it's really like your portfolio sober.
But you know what? I feel like this is so well known that it has lost its effect. But you're going to teach me something. So what is why does this work? Does it still work? Should we still
Yes,
be paying attention? Like
yes.
how what's share with us this idea of sell in May and go away and buy in October and get yourself sober. How does this work out?
Well, we call it the best 6 month switching strategy. And it was, again, something Yale discovered and published in the Stock Traders Almanac, the 87 Almanac, back in 1986 when it came out. And it's been tested and diced and sliced by academics and Mark Hulbert and all these people. And it's proven to be one of the only straight up black box systems that actually works and has predictive power and is not the result of chance. So what happens is, and what we've seen, and if you go back a few slides, there's a great line chart that illustrates this. You'll see one more, two more. There we go, right there, right here. The red line is the Dow from 1901 to 1949, which is when we were an agrarian economy fueled by agriculture,
Yeah.
where it really ramps up in the spring, buying food, fuel, seed, fertilizer, equipment, all that stuff. So people that go back prior to World War II and try to refute this are making a fallacious argument because it didn't exist. And if you look at the black line since 1950 and the green line since 1988, you see that most of the market's gains are made from November through April, with market doing pretty much next to nothing May through October. And again, you're seeing the comparison of a few different time frames here. We'll break this down further. 88, because of the 87 crash and the circuit breakers and collars that were put in after that systemically changed the stock exchange and the stock market. And 1950, because it's the big round number that everyone starts to measure things from. I would kick this back to 49 to include the first, full 4-year cycle, but this is illustrative enough. So you see the pattern here. And if you go to
Right.
the next slide, which is how we explain this to people, average performance of the Dow from November to April, 7.5%, May to October, 0.6%. Example of a hypothetical $10,000 compounded in the best months gets you a gain of $1 million. That's a one-time $10,000 investment in 1950 versus $1,000, a whole $1,000, meaning you ended up with 11,000 instead of 10,000 in the worst months. And then we use
Wow.
MACD to juice it, and we start looking for our MACD buy signal
So
on
that's where you
October
add the
1st.
technical trigger, right?
The technical trigger. I don't have to get into MACD here, but we know what it is. Again, you can see the numbers increase. And there's the trigger right there with the MACD line in the blue, crossing over the signal line in the pink. And without getting too technical, I won't go into explaining how that works. But I'm happy
Well,
to explain that at some other point.
Well, listen, I'll tell you what, we'll continue this conversation in the after hours, but let's wrap up the main part of the interview here. So, Jeff, obviously, many of our listeners want to learn more about you and what you do and where they can find more. Now, you just published the new updated version of the Stock Traders Almanac,
Yes.
right? And so, why don't you tell everyone about it a little bit, what you do, and your subscription services, and where they can find you?
Right. I mean, the Almanac book, is sold out there wherever books are sold. Of course, you can get one from me if you want. But what we really do is a investment newsletter, a digital subscription service where we take the Almanac and show people how to use it with actionable buy and sell recommendations for stocks and ETFs based upon commodity seasonalities, sector seasonalities, stock market seasonalities, and also stock picking using a fundamental screen with technical analysis overlaid, and we pick the stocks at the right time of the year, not just your stock of the month club type of newsletter. So the results speak for themselves, and it's all at stocktradersalmanac.com. I don't have a code to give you guys an offer, but
Just people reach out to Jeffrey and let him know
we'll
that you're a
send you the
Market Huddle
discount
listener.
code. Yeah, exactly, and we'll make a market code for you guys.
There you go. All right. Well, Jeff, thank you very much, and everyone stick around for more from Jeff in the after hours.